historically unprecedented levels during COVID-19. And they kept interest rates near zero and repeatedly insisted that doing so would not create inflation. And all that liquidity had to go somewhere. Much of it ended up in banks.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. I'm recording this on March 15th, and we're going to do a deep dive into how we got into this banking crisis. So it may take a week or so for this to be edited and released. So if something major changes, just please note that this is as of the 15th of March. A lot of this document has been sourced from various chats and conversations I've had with some very smart people in Puerto Rico. The summary is really from one gentleman I follow a lot. He posts a lot of thought leadership on finance, and he'd basically asked not to be named because this was posted in a private forum. But I am hoping to have him on the show at some point, and I largely agree with this. Just note that this is really me pulling together a bunch of data from people I think are very smart and where I agree with the majority of it. So how did we get here? The Fed printed an insane amount of money, historically unprecedented levels during COVID-19, and they kept interest rates near zero and repeatedly insisted that doing so would not create inflation. And all that liquidity had to go somewhere. Much of it ended up in banks. So if you use Silicon Valley Bank as an example, they doubled over the course of about a year their amount of deposits. And the deposits rose so quickly that the banks couldn't loan the money out fast enough. So what did they do with the excess? They were chasing yields, and they bought billions and billions of dollars of mid to long-term bonds. And if you think about it, when rates were close to zero, the only way they could get any yield was to, say, buy a 2% bond on the 10-year. I think the 10-year was roughly 2% at that time. And the Fed actively encouraged this bond buying, and they were promising banks, via formal guidance that it at the time wouldn't start raising rates until at least 2024. And as you know, raising rates is bad for the holder of the bonds. So this induced a lot of these banks like Silicon Valley Bank and others to buy these bonds. And Powell even said explicitly that rising inflation alone would not be sufficient to cause the Fed to raise rates. This is circa 2020. But then, with all the money printing and the supply chain issues, it really caused a spike in inflation to levels as high as the 1980s. And one note, it may not look as high, but if you follow a site called Shadow Stats, the way they calculated inflation in the 1980s, inflation is significantly higher than what they show to track inflation now. So all of a sudden this year, inflation became a little bit more of a political issue. It became something you see on the news every day, showing the CPI prints. And I don't know if it was the Fed on its own or bowing to some political pressure, but it started. They started to raise interest rates and drain liquidity out of the system. And this is over a year, maybe 2 years ahead of when it was initially promised. And not only did they start doing that, they did that at the fastest rate in history. Multiple 75 basis point increases in 1 year. And those of us that own real estate that had variable rate loans, it was a major shock to the real estate system. There's apartment complexes we're part of that luckily we have interest rate caps on on our portfolio. But rates rose over 3%, and a majority of the interest rate caps were at a 3% cap, and that was at the time seeming like a doomsday cap over a 1 or 2 year period. But those caps were hit in less than a year, and the Fed up until a week ago was still very hawkish and saying that they're going to continue to raise rates until inflation was tamed down to that 2% level. So, raising rates this fast has a devastating impact on bondholders who'd previously relied on the Fed's guidance. And especially these regional banks that were induced into buying these bonds. The losses in the bond market losses in 2022 were the worst in history for banks on a mark-to-market basis, worse than any single year of the Great Depression and worse than any single year of the great inflation of the 1970s. So these losses are staggering, and if the banks had to report them on their earnings, then in many cases that would wipe out years of prior earnings, and the stocks would have collapsed. And ultimately, a lot of stocks have collapsed anyway, just due to the market news and due to the analysis of what it may do to their balance sheet and their deposits. So many of the banks simply recharacterized a large part of their bond portfolios from marketable securities, which are liquid and supposed to be mark to market, and instead into securities intended to be held until maturity. So this is it's kind of an arcane accounting rule, but it was a way to allow the banks to not have to book the loss until the bonds were actually sold, or if it was a 3-year bond, for example, it does get redeemed at par. So if they don't sell it, ultimately they will still get their ultimate principal returned. But if they have to sell it early because the rate's lower, they'd have to take a loss. So this accounting rule kept the banks looking profitable, even though there was a lot of risk on the board of taking huge losses. So the banks looked profitable, and they're still earning interest rates on the bonds they held. However, the amount of savings deposits that they would have to pay out is much higher because the current rates are significantly higher than the rates of the bonds they were holding. And this is one of the highest spreads in history. The system was flooded with so much liquidity for so long that the banks didn't really have to compete. They didn't have to raise the rates to induce deposits. But now, with rates higher, borrowers have other options. They can move money into money market accounts or even treasuries paying 5%. And it's very difficult for these regional banks to compete on interest rate because they're only earning 2 or 3% on many of the bonds they hold. So it was difficult for them to hold on to some of the deposits. So then a couple things have happened. First, the big money started moving out of the banks, which refused to raise their rates and in some cases couldn't afford to. And they moved that money into these money market accounts or other instruments like treasuries that offered significantly higher yields. And this outflow was large and growing, and so large that some banks had to sell some of their bond portfolio to cover the withdrawals. And then under the accounting rules, selling those bonds triggered recognition of any previously unrecognized losses. So the banks were forced to sell a lot of these bonds to cover the outflows for clients moving money to other places for better yields. And their earnings started taking massive hits. In the case of Silicon Valley Bank, for example, the losses it sustained over just a few weeks wiped out years' worth of profits. Because these losses were officially recognized for accounting purposes as bonds that were being sold, the stock market reacted, and the prices of bank stocks began to collapse. The only way for banks, especially the regional ones, to stem the outflow and stop the bleeding was to raise rates that they are presently paying on deposits to something more competitive with current money market rates. But in doing so, it also destroys their profitability and jeopardizes their stock values even further, because it would reduce or in some cases eliminate the spread between what they were earning on their bonds and what they're now paying on their deposits. At a minimum, this greatly reduces their profits. At worst, it puts some of them deeply in the red. Either way, there's no good alternative. Last week, the big money finally realized what we've been describing here. They recognized that the Fed raising rates had severely impacted the business model of these regional banks, and that money would continue to flow out of them, especially regional ones, into higher yielding products until banks raise rates on their deposits, which destroys their profitability, or banks go out of business or fail because of the massive losses on their bond portfolio. Or lastly, the Fed pivots and agrees to backstop the banks, which is exactly what ended up happening on Sunday this week. So once it became obvious that the business model of the regional banks had been destroyed by the Fed and could only be saved by the Fed pivot, big money decided to call the Fed's bluff, fearing that the regional banks might fail and uninsured depositors would lose everything. They began moving away from these banks at a faster and faster rate. This caused banks to be selling more and more bonds over these outflows, triggering more losses, which triggered more panic and more outflows and more panic. This was a classic bank run. And obviously, over the weekend, the Fed blinked and agreed to allow banks to borrow money indirectly, essentially 100% financing on their bond portfolios, so that the banks don't have to sell. They can borrow 100% of the amount to cover of the face value of the bonds they hold, even though market value may be significantly lower. If you have a bond paying a 2% yield and current yields are 3.5%, say on a 10-year, that bond trades at a significantly discounted value to par if you had to sell it, but they could still borrow on the full amount to cover their deposits. So the Fed's really making an unsecured loan to these banks so that they could cover outflows without having to sell their bond portfolios and trigger the loss recognition. And this is effectively the Fed beginning to print money again. Just it's through a backdoor way. Many thought that this would be enough to end concerns that the banks would fail and to end the bank runs. However, Monday the stocks were down significantly, even despite this new promise. Tuesday the stocks did rebound significantly. However, as we write this on Wednesday, do this on Wednesday, Credit Suisse now has a panic, and the market's down significantly because of that news. And why there's still an issue is the Fed's promise of liquidity, and it really doesn't do anything to solve the underlying problem that customers at the moment can earn more money by placing their cash into money market funds or treasuries than they can by placing money in a savings account or CDs at banks. And until this issue resolves itself, it's not going to go away. And many of the regional banks will have difficulty surviving continued outflows like this. So what we think this means, and this is something I definitely agree with, is that it pushes the Fed in a direction to give up on trying to tame inflation. We'll see next week if rates actually rise, and the market sentiment still seems to be that there'll be a 25-point rise. But I think this signals that we're much closer to the end than the beginning of the Fed rates. They have caused some things to break, but there's, as I've said in various other episodes, there's a lot of other systemic factors this time causing inflation that weren't around in the 1980s. Fact is, there is a labor shortage. There's millions of less people participating in the labor force. The average baby boomer turned 65 this year. And, there are some continued supply chain issues and also just geopolitical issues, issues with Russia and Ukraine, issues with China, just materials, not the level of materials, just not flooding into the global markets like they were in the past. So ultimately, what is the lesser of two evils? And, I think what will more than likely happen is that the Fed is going to have to pivot and begin lowering rates to get things back in balance, or there could be more long-term issues with the banking sector. On top of it, just the actual national debt payments in the 1980s, the debt to GDP was 20 or 30%. Now it's I believe over 100% or close at this point. So the debt payments will become have become a much bigger part of the federal budget, federal deficit, and ultimately, I think that this pushes us in the direction of of a pivot. And last point is, some will say that the bond market follows the Fed. Others say that to some extent the Fed follows the bond market. And if you look at what's happened over the last week, the 10-year dropped significantly. I think it's at 3.4 as we speak today. The 5-year, the 2-year are all significantly below what the Fed funds rate or the SOFR rate is at the moment. So that tells you that the bond market is pricing in a reduction in rates, likely because of a recession. We'll still see what happens, whether it's a soft landing or not. But it's all signs are pointing to rates could be going back down in the coming year or 2 year. And overall, that is very good for real estate. Again, to reiterate, right now, if someone was in a bridge loan, if anyone's in a bridge loan at SOFR and the interest rates have been causing issues with cash flow, to refinance today into a 10-year, for example, most bridge loans are at SOFR, which is 4.5 plus a spread, which may be 1.5, 2%. So rates are in the sixes. However, refinancing into a 10-year right now would be at 3.4 plus about 180 basis points, so 5.2%. So there's a lot of owners right now who could refinance and save a significant amount of money on a rate by going in long term, and that's good for real estate syndications because that protects the exit, that protects the cap rates on the exit. The lower the interest rates are for long-term fixed rate debt, the better chance of selling at a solid cap rate that's still the lower the cap rate, the better for an exit. So even though cap rate is not factored into interest aren't factored into the actual cap rate calculation, the lower the rate generally allows for a tighter cap rate. So that's about it for today's episode. A lot of detail here. Hopefully that was I know there's a ton of stuff being posted everywhere. I hope that's a helpful summary of how we got to where we are and why we may be closer to a Fed pivot than we might have originally thought. So that's about it. See you all in the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.